So cap markets, sadly I missed all of yesterday. I was in Amsterdam with our research team, which was actually pretty interesting, looking at some of the trends that are actually now impacting the Dutch market, which we will start to see in the CEE markets, and we'll go through some of that through the presentation and how that's going to affect capital flows, the capital markets. So this title is from research that we started at the end of last year, which we launched at MIPIM, and it's a product view from the top. Are we at the top of the market? For many markets we undoubtedly are, but to what extent will we keep rolling on, or will we see cyclical change? And certainly there's a few investors out there who feel that they're walking a tightrope across the market. So 2015 was a really strong year for investment, not quite at the peak of 2007 in terms of volumes, but pretty close to reaching that point. Obviously, different conditions for different markets. And the conditions that were driving that, we've had a look as to whether those conditions that were driving a successful 2015 are still active in 2016. But the clear difference, and it clearly came out of the discussions yesterday, is geopolitical market volatility is on the up, and that's making a lot of investors pause for cause, decide what they're going to do and where they're going to do it. But it's also creating some opportunities for other types of investors to get in while the institutions are pausing. But some of the other conditions are still pretty positive, the fundamentals that are driving it. So low interest rates, I don't think that we'll see a change to that in the UK until at least the end of this year, if not next year. Change in interest rates for the EU still doesn't look like it's going to change until 2020. Now, that may come in at some point, particularly when we consider labour markets, but we'll come on to that a bit later. Debt leverage still widely available, and it is extending. It's moving further and further out, which is a good thing for Central and Eastern Europe, particularly away from Poland and Czech, where the markets are pretty strong. And it's also conservatively priced because the banks are bidding against each other quite aggressively, and that's making the cost of debt pretty low, which is healthy for the market. Weight of capital is still strong, and it continues to increase. We'll come on to that shortly. And it's increasingly cross-border, and it's increasingly global. And what we're also seeing is the development cycle is now starting to kick back in. So land acquisitions were significantly up last year. It was one of the strongest changes in terms of investment turnover. And we're starting to see more development happening across the board, which is obviously healthy for the capital markets guys because they're going to need new product to buy. Risks. Now, there's lots of them. This certainly isn't all of them. Some of these are short-term, and some of these are much, much longer-term. And we'll run through some of these, the longer-term ones, a little bit through the presentation. But you know, the China crisis, we had the equity wobble, and we'll see the impact of that shortly. Slowing global growth from China. I mean, it's slowing, but it's not collapsing. Low oil, we've got low commodity prices, and that's definitely got issues for a lot of emerging markets, as well as the BRICS markets. We can see that in Brazil and Venezuela and Indonesia, Malaysia, lots of different places. Closer to home, clearly politics, fear of more nationalist politics and the breakup of the EU. Whether Brexit will actually bring that about, it seems unlikely. I've got a slide at the very end which looks at the betting in the UK. And you can see that the bets for whether the UK stays in or out have been firmly in, and now the bookies have stopped taking any bets. So they do believe that the UK will stay in, which should not, hopefully, trigger a wider sort of disruption across the Schengen zone. Longer term, we've got clear demographic pressures on the markets, and that's already changing real estate demand, and it will significantly change real estate demand going forward. And then there's the whole sustainability agenda, which I think some markets are embracing, but some are not even really fully considering it, or the full extent of it in terms of resource efficiency and how to manage that. So if you look at the impact on equity markets at the start of the year, and then what the change was to April from all of this geopolitical volatility across the markets. So by January, as a result of what was going on in the world, the FTSE was down, S&P was down, Shanghai index was down, EPRA UK. Now EPRA UK is the listed real estate body which monitors the listed real estate sector in the UK. Share index movements were down, EPRA Eurozone was down. We get to April, and there's quite a bit of change, or end of April. So FTSE's back up, S&P was back up, Shanghai is actually further down, EPRA UK is even further down, but EPRA Eurozone is actually back up positively. So it looks like the market is pricing in, rather than broadly, more directly, concerns about Brexit. Now, is that a cyclical position or is it a Brexit position? It's probably a combination of both. We'll see what happens in the end of June once the vote is done, and we do think we'll see a big push back into that market. But China is still obviously a problem for a lot of investors, with that share price still moving negatively. In terms of capital flows, allocations continue to increase into real estate, and even small percentage changes are worth trillions of dollars. So there's more and more capital coming into the market. It's getting more global. I think high net worth individuals now in Asia outnumber those in North America for the first time, and that is rapidly increasing. And we're seeing a lot more capital coming out of Asia, out of China, new waves of it just emerging and moving into the market. And they do have slightly different positions in what they want to actually invest in. So that's a good thing for the market, provided they can actually find product and they don't cause too much price inflation. Because one of the big challenges for them, GIO is a report that we do, Global Investor Outlook, so we review the sentiment, opinions of lots of investors globally. They're not so concerned about performance, i.e. getting returns. Only 6% saw that as a concern. 27% cited fundraising, but 56% said finding opportunities that actually match their long-term needs, long-term liabilities, is increasingly an issue. And that is going to be the real challenge for the market. So what's quite interesting to see across Europe is, as you can see, by the end of 2015, volumes are pretty much back to where they were in 2007. But the actual diversity of where the money is going is changing, and it's actually changed since 2009. So the traditional real estate sectors at the bottom, office, retail, industrial, obviously still growing, but what we're seeing is much more investment going into residential and an awful lot more going into hotels. So hotels was actually the biggest expander in the last year, and there's definitely a lot of rationale for both. Offices looks like it's flattening off. Retail was growing, but retail was driven by some pretty big transactions last year. Whether it grows at the same rate for this year seems a little bit unlikely. But what you'd actually see if you looked at this for CEE is a fairly different picture. You wouldn't really see hotels, there wouldn't be any residential, and there'd be a lot more industrial within that split. And that shows how CEE is quite different. And if you look at it at a country level, you can really see the difference. So this shows total investment by different country, by different sector, from 2007 till the end of 2015. So we've got CEE markets on the right, kind of mix, Benelux, Spain, Italy, Southern Europe, Nordics, and the Netherlands on the left here. That line should be there, never mind. But the other thing you can see is, I mean, clearly volumes are lower across these countries relative to everywhere else, and that's a function of value, it's a function of yield, it's a function of rents. But it's the diversity part. I mean, it's clear there's a lack of investment into these alternative sectors that you're seeing in more of these established markets. So the question is, to what extent will that change? Because, quite frankly, it is going to need to change. The pricing side of things, yields in CEE relative to the Tier 2 average, you can see the pressure of investment going into other Tier 2 markets last year, forcing yields down. Yields in Prague, Warsaw, just above that, and then you've got Budapest and Bucharest above that again. Now that's the kind of natural order of things. We'll probably see a little bit of compression within that. But from a pricing perspective, CEE still makes a lot of sense relative to these other markets. In terms of rents, there's no point putting a rents chart up, because for all markets it's just flat, apart from Warsaw prime rents, which have gradually crept down. But what we're also seeing is, vacancy has actually been going up in Prague and Warsaw, but is finally starting to flatten out. So that will at least sustain rents, or it should maybe the end of the Warsaw rental vacancy issue. But we're seeing vacancy come down in Budapest and Bucharest. I don't think it will drive any significant growth in rents, because it never has. And when you look at the employment trends and the space use trends, I don't think it will. So, disruptive forces. I think that was part of the conversation quite significantly yesterday. The traditional demand model for real estate is GDP, it's employment, it's consumer spending. It's how that's changing. The availability of finance, other macro factors. But what really drives change, drives disruption is a combination of technology, legislation rather than regulation, because it's regulation with teeth, and politics, and then everything else, the market, real estate responds to that. Now, demographics has kind of been on the outside, influencing consumer spending, but it's now at the heart of change in Europe, and I think that we'll see that moving forward, because we've got a significantly aging population and a declining working population across the board. So it's all going to be about war for talent, winners and losers. How do you get that talent? What's your vision to keep that talent? Demographics, a range of different countries. UK looks all right, although it is trying to stem its migration flow. France, interesting, looks okay in terms of growth of its overall population, but the pale blue bar is your working population. So Russia doesn't have a particularly good story, nor does Germany. Yeah, I mean, Germany's is actually pretty amazing in terms of its declining working population. And this is across the board. Now, we've been going on about this for a good few years. And what I saw in the FT a few days ago was this was reported. So this is Eastern European migration change. And it shows the extent to which there has been pretty significant population loss in this part of the world. So from the early 90s, from joining the EU, the liberalization of markets, there's been significant outward migration. The good thing is it's started to flatten off. The bad news is it looks like it's increasing again. So what's even more interesting, and some of these numbers don't really stack up for me, I didn't realize Ukraine had seen population growth or net inward migration, but there you go. Maybe it has. It seems to be concentrated in the Balkans and the Baltics. Czech Republic looks good, Hungary's positive, Slovakia pretty even, but Poland is a little bit negative. It has lost a lot of its population. Can it bring its population back? Can it sustain jobs growth? Because the employment markets across Europe and in these core parts of Central and Eastern Europe are pretty much hitting employment capacity now. Now, we did quite a bit of work for manufacturing companies, for some outsourcing companies, and they're really, really having to question where they can get to set up an operation that's not going to give them a labor market retention headache. And it's becoming more and more difficult as to where they can actually get to set up their operation. On the more positive side, the region has seen a hell of a lot of jobs growth coming from the outsourcing industry, and this is all about the whole technological part of disruption. So back in the 80s, before the internet really existed, there was no really global outsourcing. By the 1990s, as a result of MNCs getting into India, setting up operations, realizing they can actually run back office operations from Bangalore at an nth of the cost, we saw global outsourcing born, essentially. CEE came next. And then by 2005 to 2015, there's been growth of from 1 million to 5 million jobs in shared service centers in 10 years. And this region has been a massive beneficiary of that. Now, that's just shared service centers. It's not the whole outsourcing industry. So you add that on top, and you've got a much, much bigger number in terms of the jobs that are being outsourced. And that will, and it is continuing to grow. It's not stopping. It's changing, but it's not stopping. So if you look at the last 10 years in Europe in terms of office employment and change in office employment, some pretty interesting findings. So this is the change in office jobs growth over 10 years. So the big winners, Southeast Europe, Visegrad 4, Poland, Czech, Slovakia, Hungary. The Baltics are up there, and then in the middle you've got the Nordics, UK and Ireland. Western Europe has barely seen any jobs growth. Southern Europe is actually negative. So for the Central and Eastern European markets, it's all about outsourcing and how that's actually driven jobs growth and bringing companies in and creating new jobs around that. UK and Ireland and the Nordics, it's a lot more about having much more liberal economies that are more flexible and that can react to change quicker and drive change and drive growth. It's clearly something Southern Europe hasn't done particularly well. But last year, Spain has changed its labor laws, so it created 500,000 new jobs. No, yeah, I think that's right. Italy's following suit. Portugal is following suit. So we're actually seeing a completely fundamental change in the labor structure of Europe. So we're going far more full-time employment, contractual, to part-time and contractual workforce. So if you look at overall, full-time permanent contracts is actually down over 10 years. Part-time contracts are massively up. Temporary contracts are also up. Interestingly, self-employed is down. Some markets it's up, in the Nordics, in the UK and Ireland. It doesn't really exist in Central and Eastern Europe. And that's another thing that Central and Eastern Europe really needs to encourage, to develop, to grow, to help grow its economy, the SME part of its economy. So if we look at it collectively, employment peaked around 2008. By the end of this year, we should see it get above peak, 105 million. Now, if it follows GDP projections, it says that office-based jobs will continue to grow, which is great news for the office market. More bums on seats. But, well, one, our GDP forecast is going to be right. That's number one issue. Probably not. But also, I think the ratio of office employment to GDP and the use of space is completely changing. So I think this will be a much, much flatter curve. One reason for that is automated software that's being introduced to a lot of companies, not just in outsourcing organizations, where they can actually automate processes. It's also being introduced into mature markets. So there was a big legal company in the UK announced 2 weeks ago that it's created some software where they can do 100 hours of contract work in 2 seconds. That's a pretty big change. Yeah, they'll probably bill you for the 100 hours, but there you go. I'd be disappointed if they didn't. But this is coming, and this is going to impact office employment. And also in terms of just how we use office space, what's in the office space has changed significantly in the last 10 years. If everything used to be in the office, from your servers, your archiving, your back office, or your management back, mid, front office, servers are out, back office is out, it's outsourced or it's in a shared service center. You still had this around 2010, all the other functions, but now you've got a lot more flexibility being introduced into your sales teams. You've got the likes of Regis and WeWork, who are growing quite expansively and picking up some of that space. And certainly from a lot of the occupiers we've been talking to recently in TMT, one of their key priorities is desk utilization and increasing that ratio, because there's too many desks per person and they want to use space much, much more efficiently. We are starting to see that in some markets in Central and Eastern Europe as well. Colliers itself has adopted it. So that is going to minimize how much space we need. What's interesting about CEE, the blue bar represents the amount of meters squared per workplace. The black bar represents the cost of operating that space per person. So in CEE, we're actually pretty efficient. We don't use as much space per person, and the cost of that space is actually lower than everywhere else, which is one of the reasons why BPOs or shared service centers come into this market, but it's also a function of shared service centers being in this market. You get into the Nordics and the Dutch market, you've got a completely different picture. A lot of space per person. So there's definitely a lot of hidden vacancy in some of these markets. We're doing some work at the minute on the Netherlands, at just how extensive that is, and it looks like it's a pretty big number. Finland, of course, I'll do my sauna joke. So, take the sauna out of the office and you wouldn't have as much space per person. But apparently there's about 1.5 million square meters of hidden vacancy in the Helsinki market. So it's just not actually been put back onto the market yet. And all of these markets, if we go to a 10 meters squared utilization rate, there's going to be a lot more stock coming on, and it's what you do with that space. So what you do with it, the positive side is, as I said, hotel capital market investment has been on the up. Resi is definitely on the up. We're doing some work with Airbnb. We're looking across different cities. I can't tell you the figures because I'll get shot by my head of EMEA hotels, but the figures for Amsterdam are staggering in terms of the growth of Airbnb, and that's in a very controlled market. The growth in overnight stays is growing per se and for the hotel industry, but the difference is pretty amazing. But if we look at the growth in overnight stays globally, that demand curve is huge in terms of the growth for the need for hotels, for Airbnb, for more residential, for service departments. And that's probably what's driving investment into the sector. But it's where that demand is coming from. And again, a lot of it's coming from Asia, from China. So the US has always dominated overnight travel. China's only about 6 million behind. It may, at some point, overtake the US as the biggest global travelers. We don't know. But what's interesting about that is not just the number, it's what they actually want. And what they want is a far more personalized service. And another bit of work that we've done recently, which will be out next week, looks at the review system of all hotels across European locations. And the common denominator is everybody feels they don't get value for money out of hotels. So Airbnb, experience economy could actually really fill that space. It's really interesting, and it's interesting just how quickly it's changing. Again, technology, how it's disrupting, how it's changing things. Obviously, online retailing has been a massive changer across Europe, particularly in the UK. We did quite a bit of research last year looking at what the requirement could be across different European locations for new warehousing space that comes out of a combination of population growth, consumer spending, and the need for more warehousing. 5 million square meters is a pretty big requirement. It doesn't mean that much space is going to be needed to be developed. There's going to be some efficiencies in terms of existing space that can absorb some of this functionality, but there's still going to be a huge amount of push for demand for it. You've got fairly different growth curves across the market, and that's without accounting for existing operations that can't actually facilitate modern multi-channel retail logistics. How's it going to be distributed? It's going to be distributed everywhere from port-centric logistics, and we're seeing some pretty significant change in this in the last 5 years, and we will continue to see big change. The shift towards multimodal. Most of the big ports now have got changing targets for how freight is actually shipped, and they're all already starting to move stuff onto rail and to inland waterways. So that creates demand for multimodal hubs to redistribute to the edges of towns and cities for cross-docking and for urban logistics within cities. So again, when we go back to the regulation, the sustainability part of the argument, this is all about CO2 emissions and managing it. It's also about the actual cost and bringing that down. But if there's a target by 2030 to have emissions-free logistics in every European city, you're going to see a lot of growth in electrified vans, cargo bikes, combined with the demand from the retail side to actually get product to you on the same day or next day. And this is just a summary slide, essentially. All the change, we've gone away from traditional standalone sectors. Sectors are morphing together. A lack of demand at one is creating opportunities for another, and it's going to start impacting Central and Eastern Europe. It already is. I was in Prague a month ago, and I think they're looking at their first sort of private sector, possibly student housing development. A couple of guys are actually looking at it now. So those niches are actually starting to filter into the market, in a market where 5 years ago they said, no, that'll never happen. These things will happen. There was an interesting article about urban farms on Property EU last week. It may seem utterly ridiculous, but if you've got space that needs to be, essentially demolished and reused, things like urban farms are a potential opportunity. So we're moving away from traditional, and we're definitely moving into a completely new age of what is needed, and the capital markets industry needs to shift towards that. It already looks like it is, but I think the level of expertise or experience in a lot of these niches is not quite there yet, even in the mature markets. Even in the UK, senior housing has clearly got a massive potential, but there's only about 2 operators in the UK that are involved in that sector. So there's a lot of potential for change. Pleasure. Thank you.